Dr. J. Mahamayi, Associate Professor of Commerce, V.V. Vaniyaperumal College for Women, Virudhunagar. Yes, I am very proud to take the topic, the types of assessment. First, one should know about what is assessment. Assessment is nothing but computation of tax liability of a person, maybe a HUF or a company or a AOP. Assessment is nothing but computation of tax liability. One should know how we are going to pay as a tax. The types of assessment may be self-assessment, regular assessment, best judgment assessment, income escaping assessment. Let me see one by one. First one is self-assessment. In the case of self-assessment, one person before filing the return of income, he has to compute what will be the total amount of tax is going to be paid in future. He has to compute as his own without filing any records, IT returns. After computing advance payment of tax and tax deducted at source. So, any person who voluntarily make the computation of tax before filing the return of income, after considering the advance payment of tax and tax deducted at source, he may voluntarily file any return and pay the tax. It is called as self-assessment. The assessee is required to pay the tax before filing the return. It is mandatory for a person to pay interest payable up to the date of filing return of income. If there is any default or shortfall in the payment of tax, whatever amount so far paid is first adjusted towards interest. Afterwards, it would be computed for payment of tax. Next is regular assessment. It is done by the assessing officer. The assessing officer is a person who has to compute the tax liability for the person, HUF, company or LOU or AOP. In that case, the person has to compute the tax liability and he has to file the return either on its own or with the help of e-filing. After filing is carried over, the assessing officer has to compute the tax liability. First, he has to see whether all heads of income are included. Income from house property, income from salary, income from capital gains, income from business or profession, and income from other sources. He has to add all these items. Now it is called as gross total income. Out of this gross total income, deductions up to 80C to 80U has been deducted. The taxable amount is called as net taxable income. Out of the net taxable income, the tax rate for the current assessment year 24-25 is applied, and up to 2,50,000 nil, and afterwards it will vary 5%, 10%, 20, 30, and he has to put the surcharge. If there any person is allowable for rebate, he has also be computed. So the total tax liability is computed and the intimation is made to the assessee. After receiving the intimation from the assessing officer, the assessee has to make a payment of tax. It is called as regular assessment. In case of self-assessment, the person has to make the compute the tax on its own and he has to make the tax liability. In case of regular assessment, as usual, the assessing officer has to make a amount of tax and he has to call upon the assessee to pay the tax liability. Next one is best judgment assessment. It is also made by the assessee at the own discretion according to judgment of its own. What will be the tax in future? He has to compute. It is same like the self-assessment. The assessing officer, after considering all the relevant material facts which has to be gathered, he has to make the assessment on his own discretion. It is called as best judgment assessment. The best judgment assessment is done in the following cases. First one, if any assessee fails to make any return and the person fails to comply with the notice or fails to comply with the direction, require him to get his account audited. So whatever any commitment or fraud committed by any assessee, according to own judgment, the assessing officer has to take decision about the tax liability. Next one is income escaping assessment. In that case, any assessee escaped his income. He has to concealed some sort of material facts. Sometimes he may ignore some material facts. For example, if a person is having two houses, one is self-occupied and another is let out, he completely ignore or conceal the house which has been let out, and he has to say that I am having only one house. Any income he has concealed. Similarly, another example, income from other sources. For example, income for a college professor. Income from salary has been actually added in the gross total income, but he has to make some extra remuneration, supervisor, and he has to make this lecture, and he has to receive some extra remuneration, or he has put FD interest in the bank. He has concealed that I am not having no income. But any income escaped in the eye of the assessing officer. After that, he has to find that some sort of income has been escaped out of the tax liability. He has to call upon the assessee to pay the tax for escaped income. So it is called income escaped assessment. The following are the cases the income escaping assessment is carried on. Number 1, no return of income has been furnished by the assessee. Where return of income has been furnished but no assessment has been done, where the assessment has been made but income chargeable to RAM is under assessed. What are the consequences of judgment assessment? The assessee becomes liable to penalty, prosecution, etc. Next one is provisional assessment. According to the Income Tax Act 1961, the provisional assessment is done if the return of income is filed under section 139, the tax paid by the assessee exceed the assessed tax payable, the IT officer thinks fit that the regular assessment is impossible within a short period. So, at the time being, just we have to refer certain items and we have to make assessment. It is called as provisional assessment. Thank you.